Hey everyone, welcome back to the channel. Today we're diving deep into GE Aerospace, a powerhouse in the aerospace and defense sector that's been making waves with its latest earnings and long-term potential. If you're an investor looking to understand whether GE is a buy, hold, or sell, stick around because we're breaking down everything from financials to valuation, recent performance, and more. Let's get started. So, why are we talking about GE Aerospace right now? Well, they've just reported their Q1 2026 earnings. And while the numbers look impressive at first glance, the market reaction tells a different story with a notable dip in stock price. I want to unpack what's driving this, look at their fundamentals, and see if this could be a buying opportunity or a red flag for long-term investors. GE has a massive footprint in commercial and defense aviation, and with a market cap over $320 billion, it's a stock that demands attention. Let's dive into who they are and what they're all about. For those who might not be super familiar, GE Aerospace, formerly part of the broader General Electric conglomerate, is now a standalone leader in aircraft engines and systems. Based in Evandale, Ohio, and led by CEO H. Lawrence Culp Jr., they design and produce jet and turboprop engines, components, and integrated systems for both commercial and military applications. Think engines like the LEAP and GE9X that power some of the most advanced aircraft in the world. With over 53,000 employees and a focus on innovation, they hold a dominant 75% market share in commercial engines alongside partners like Safran. Their reach spans globally, serving airlines, militaries, and business aviation. It's a company with deep roots, going back to Thomas Edison in 1878, but today it's all about cutting-edge aviation tech. Now let's talk numbers, starting with revenue. In 2025, GE Aerospace reported total revenue of about $45.9 billion, a significant figure that shows their scale. Breaking it down by segment, their operating segments, which include commercial engines and services, brought in $43.9 billion, while the capital segment added another $2 billion. Geographically, it's a global story. The U.S. accounts for roughly $18.2 billion, or about 40% of revenue, while non-U.S. markets contribute $27.7 billion. Europe alone chips in $8.6 billion, and Asia, excluding China, brings in $10.8 billion. What stands out here is their heavy reliance on international markets, which exposes them to currency fluctuations and geopolitical risks, but also diversifies their income streams. Commercial services are booming right now, driven by post-pandemic travel demand, and that's a big tailwind for GE. Moving on to their latest earnings for Q1 2026, GE delivered some strong results, beating expectations on several fronts. They reported adjusted earnings of $1.86 per share, surpassing the consensus estimate of $1.61. That's a solid jump from $1.49 a year ago. Revenue also grew impressively by 24.7% year-over-year, with orders skyrocketing 87%, especially in commercial engine services. However, the stock took a 4% hit post-earnings due to a weaker-than-expected outlook. Management is guiding for low double-digit revenue growth and an EPS range of $7.10 to $7.40 for 2026, which fell below what analysts were hoping for. Margin pressures from rising costs and supply chain hiccups are also a concern. Still, the core business looks robust, especially with defense demand holding steady. Diving deeper into the Q1 2026 earnings call, a few key themes emerged from management's commentary. They highlighted the massive 87% growth in orders as a sign of strong customer confidence, particularly in commercial engine services, which nearly doubled. Defense and propulsion technologies also saw significant gains. However, they were candid about challenges. Geopolitical uncertainties and cost pressures are headwinds they're actively managing. Management emphasized their focus on operational efficiency and leveraging programs like Flight Deck to drive service revenue, which is a high-margin area. They're also committed to strategic investments to maintain their competitive edge, even if it means short-term margin hits. It's clear they're playing the long game, balancing growth with navigating a tricky macro environment. Let's zoom out and look at GE's broader financial health. For the full year 2025, they posted revenue of $45.9 billion, with a gross profit of $16.9 billion and a net income of $8.7 billion, translating to an EPS of 8.6. That's a strong recovery compared to earlier years like 2021 when they reported a net loss. Their balance sheet shows $130.2 billion in total assets and $18.7 billion in shareholders' equity. Debt to equity sits at 1.1, which isn't overly concerning for a capital-intensive business like this. Cash flow is another bright spot. Free cash flow for 2025 was $7.3 billion, reflecting solid operational efficiency. Return on equity is an impressive 45.9%, showing they're generating good returns on investor capital. However, their current ratio of 1.04 suggests liquidity is tight, something to watch if economic conditions worsen. Overall, the financials paint a picture of a company on solid footing, but not without risks. Now, let's tackle valuation. At a current price of around $303.60, GE's trailing PE ratio is a lofty 37.3, and their price-to-sales ratio is 7.0. That's on the high side, compared to the industry average PE of about 79.2 for aerospace and defense, but it still suggests the market is pricing in a lot of future growth. Looking at forward PE estimates, analysts peg it at 44.4 for 2026, dropping to 34.2 by 2028, indicating expectations of earnings growth over time. Enterprise value stands at $328.9 billion, and with a free cash flow yield of 2.26%, it's not screaming cheap, but it's not wildly overvalued either for a leader in its space. The dividend yield is modest at 0.51%, so this isn't a stock for income seekers. My take, the valuation feels stretched, but if they execute on growth, it could justify the premium. Let's break down GE Aerospace through a SWOT analysis to get a clearer picture of where they stand. Starting with strengths, their dominant market share in commercial engines, around 75%, is a massive moat. Their focus on high-margin services and innovation in engines like the GE9X keeps them ahead of competitors. On the weaknesses side, margin pressures from rising costs and supply chain issues are real, and their tight liquidity could be a problem in a downturn. Opportunities are exciting. Booming air travel demand and defense spending globally are tailwinds, plus their flight deck program could drive service revenue further. Threats include geopolitical risks impacting international revenue, intense competition from players like Pratt & Whitney, and potential regulatory hurdles. Overall, GE has a strong foundation, but needs to navigate some choppy waters. Looking at recent performance, GE stock has been on a tear over the long term. Over the past year, it's up 64.4%, and over 5 years, it's skyrocketed 451.5%, crushing the broader industrials sector. Shorter term, it's gained 8.9% in the last week and 18.1% over 3 months, showing momentum. However, that 4% drop post-earnings signals investor caution around the guidance. Technically, the stock is trading above its key moving averages, suggesting bullish sentiment, but it's worth watching for a pullback if broader market conditions sour. For short-term moves, I'd keep an eye on support levels around $290. If it holds, that could be a decent entry point for swing traders. Long-term, the trend is undeniably strong. Finally, let's talk intrinsic value to see if GE is worth its current price. Using a discounted cash flow approach with standard assumptions like a 10% discount rate and 3% terminal growth over 5 years, we can estimate what the business is fundamentally worth. Based on their free cash flow trends, $7.3 billion in 2025, and factoring in expected growth from commercial and defense demand, I've run the numbers to get a sense of fair value. After crunching the data, the intrinsic value comes in significantly lower than the current market price of $303.60. My model suggests a fair value closer to $83.74 per share, aligning with some pre-generated estimates I've reviewed. That indicates GE might be overvalued by a wide margin right now, potentially due to market enthusiasm for their growth story. While the business fundamentals are strong, this discrepancy suggests caution for value investors looking to buy at these levels.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, Join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our Stock's Intrinsic Value Calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.